Hello, everybody. My name is Stacy Yanchuk-Oleksy, and I'm the CEO of Money Mentors, a nonprofit financial counseling agency based here in Alberta. Today, what we're talking about is budgeting for small business owners. So who we are a nonprofit agency, and we provide free financial counseling and education to any Albertan who reaches out to us. And we also administer the Orderly Payment of Debt program on behalf of the Government of Alberta. So budgeting, right? Why bother? It's not that much fun. But the benefits of budgeting, especially if you're self-employed, is it keeps you on track. It can reduce your stress. It gets you in control of your finances, helps with cash flow. It gets you, you can get better credit for it. And it's really important to remember that there's no right way to budget. There's the right way that works for you and your household. And especially for self-employed folks, right? What we see is that, there's a combination of personal finance and business finance all in the same account. And what we want to do is help you pull those apart to keep your stress down so that you can focus on your business. Okay, so getting organized. This is the first step, right? And what organization does is it keeps you on track. Because have you ever noticed if you've got your receipts stuffed in your car or you've got papers everywhere, just how much more stress it feels mentally? So what we want to do is get organized so it keeps our stress down. And then it allows you to make information-based decisions instead of emotional decisions. And like I said, it'll reduce your stress. So what should you include in your organization? Well, your monthly expenses, and this is where I've separated out personal and business, right? So you've got monthly expenses, your bank accounts, your taxes. You want to have those in separate folders. Okay, any utilities, certainly for personal. Now, if it's relevant for your business, of course, keep that. Investments and retirement, that's personal. Insurance, you're going to have business insurance as well as personal, so keep those separate, but in their own folders, right? Credit products, if you have any for business. Certifications, if applicable. Pet information, that's personal, of course. Although my husband, who's self-employed, calls our dog the chief marketing officer. His name is Duke. Your estate plan is personal, but you may need one for your business, and any legal documents that you have. And then I always like to create the in case something happens to me document, which means this is just a one-page document for your family, whoever is, taking care of your business or your business, right? To know exactly where your accounts are, where your insurance is, your life insurance, et cetera, so that people have information instead of reacting so emotionally during such a stressful time. So methods of organizing, right? You can use file folders. I do. Desktop folders, online system. But regardless of how you do this, it's important that you maintain your security and take the time every month to update your files. It's a whole lot easier to do so, once a month or once a quarter than at the end of 12 months. And then just enjoy the peace of mind that you've got, knowing that your information is available right at your fingertips and you can access it right away. Okay, so I'm going to be honest, this is not a lot of fun, this opportunity, which is about tracking expenses. So have you ever asked yourself in your head, like, where did all my money go this month? Or how do I have more month to go, but not enough money to last? Well, the key is tracking our expenses because oftentimes we don't know exactly where our money is going and we're surprised when we do start to track it. So the challenge that I'm going to offer to each of you is actually track your expenses for a month. It's not that much fun, but it can actually save you a lot of money because it tells you exactly where your money is going, not where you hope or think it's going to go. There are a couple different ways you can do this, right? You can do it with a tracking app on your phone. We want to be very careful with those because if they are pulling information from your accounts, which is essentially screen scraping, it can actually null and void your CDIC protection, your Canadian, oh my goodness, Deposit Insurance Corporation, right? So when you put your money in a bank, it's protected up to 100,000, right? And so we don't want to null and void that. So be careful. You can kick it old school and use just pen and paper. That works fine too. You can use an app, you can use Excel, you can use whatever works for you. But the key is that if you spend over 10 cents, you write it down just for a month. And then you really get to notice where your money's actually going. And that allows you to make some informed decisions. So now let's talk about paycheck planning. But first we have to talk about types of expenses. But I'm going to tell you that paycheck planning was a game changer for me. So how it works is that we have multiple or we have different types of expenses, right? We have fixed expenses. So these are on the same day of every month and they are the same amount. So this would be like your rent or your mortgage. It may be your car insurance, okay? But they are fixed and they're predictable. The cash and variable expenses, on the other hand, happen every month, but they go on different days and they can vary in a bit. They can vary in amount. So think about gas, groceries, entertainment, eating out. Then we have our irregular or seasonal expenses. So those are those odd ones that come up that always end up breaking our budget that we have to use our credit card for. So think of holidays. Christmas comes around every year, right? The birthdays. If you have pets, I mean, I love my dog, but man, is he expensive when he goes to the vet, right? Going on vacation. Those are seasonal and irregular expenses. We also have savings expenses, and savings is an expense because even though we're putting it into savings, we have intention to spend it later, right? So this is whether that's emergencies, your goals, or retirement, right? Those are expenses. And then finally, what you've got is your business expenses. Okay, so then what we want to look at is your paycheck frequency. How often are you getting paid through your business, by paying yourself, right? Or maybe you have a part-time gig. How often are you getting paid? Okay, and then how often is there household income? If you share your household with others, right, is there other income that's coming in? And then what we do is we use the multiple bank account system, right? So I have multiple bank accounts. So I've got a bank account for my fixed bills. It is a checking account, just a plain old no-fee checking account. And what I do is I move money every paycheck into that bills account so that money is automatically deducted out. I never operate there out of that account. I have a cash and variable expenses bill or account, and that's really for gas, groceries, and entertainment. So we put money in there every paycheck, and that's what we use. And then we have, of course, the savings. So emergencies, goals and retirement. And then you may have your business account as well. So as I mentioned with fixed bills, what we want to do is add them all up. Okay, so you would go through a list of what are your fixed expenses, add them all up, and then divide that by your pay frequency. So if you pay yourself once a month, then you divide it obviously just by one. So every paycheck you have to move that whole amount over into your fixed bills account. Now, if you get paid every 2 weeks or twice a month, then you do that every 2 weeks or twice a month. Okay, or if you do it weekly, same thing, it's 4 times a month. Okay, and then you deposit that money into your fixed bills account and you leave it be, and then money will automatically get deducted out. So as I call it, it's the set it and forget it. Okay, just don't operate out of this account. That's crucial. Now the cash and variable expenses account. So again, add up all your household expenses. Okay, so those are gas, groceries, entertainment, etc. Divide by your pay frequency, and then move that money every paycheck into your cash and variable expenses account. And that's where you operate out of. Okay. The irregular and seasonal expenses. So, think about what happens in your life that you need to. So oil changes and car tune-ups. It could be vacations. It could be kids going to camp. It could be anything, right? Add those up, okay, including clothing and shoes, because we don't typically buy $50 of clothing and shoes every month, right? We buy them in seasons often. Again, divide by so divide the total, okay, by your pay frequency, but you're doing it over the year, right? So if you do it monthly, you pay yourself, then it's 12. If it's twice a month, it's 24. If it's biweekly, it's 26. And then obviously if it's weekly, it's 52. And then deposit that into your regular and seasonal expenses account. And then you can pull money out when those expenses come up. Okay, so this is what it looks like. Now, this is a bit messy, but you can see here, right? We've got our fixed bills, okay, rent, insurance, car payments, cash and variable with gas, groceries, and entertainment, irregular and seasonal expenses, okay, and then our savings. And then what I've done is I've broken it down by if you did it every week, what you'd have to transfer over. If you did it bi-weekly, so 26 paydays, semi-monthly, so twice a month, as well as monthly, what that would look like. Okay, so dealing with seasonal and irregular income, this can be really tough, especially if you're a solopreneur, right? You're on your own. You can have big months and you can have really lean months. And so a really cool technique that I've learned and taught of is called the holding account system. So this is again where you're using multiple accounts, but you have a holding account. And that means every piece of income, every dollar earned goes into that holding account. And then what you do is you pay yourself out of that account. And whether you pay yourself weekly, bi-weekly, twice a month, or monthly, you're going to pull that money out. And so what that means is that for your bigger months, your higher income months, it increases your holding account amount, right? It pads your budget, but you just still withdraw your normal amounts. But on the lean months, that's where you're depending on the bigger months, right? But it allows you to keep it all into one account, and then you pay yourself out of that account to deal with your expenses. Okay, so when it comes to business and credit, oftentimes solopreneurs are using personal credit, right, to leverage their business. It is what it is because it can be tough to be in business and get credit, right? So that's why it's really important that we understand our own credit and we understand how it works. Okay, so here's what we're going to talk about. So, why is credit important? How does my personal credit impact my business? What's a credit report, a credit score, credit ratings, and how can I improve that? Okay. So what a credit, as we know, credit ratings, or let me go back for a quick sec. Why is credit important? Credit's important because it allows you to pay for things as simple as parking or as big as equipment for your business, right? It allows you to buy something without having the cash available. But again, it's really important that we keep good credit so that we can manage our business as well. Because bad credit will impact how fast you can expand your business. So credit reports, think of a credit report as your resume, right? But it's a resume of your credit products. So it's a detailed history of all of your credit products and how you've behaved with them. So what that means is, so what will show up on your credit report will be your personal information. So your name, your address, etc. Some of your job history will be there. There's a section for a consumer statement where you could put a statement on on your credit report. We have public records, so whether somebody's been bankrupt or actually insolvent, a consumer proposal or bankrupt. And then credit, it'll list credit that's been applied for the last 3 years. And then your trade lines, which are all your credit products. Okay. It's really important that we all understand our credit reports. I don't check it every month. That's a bit too much for me, but I check my credit report every year because the reality is if my credit report is accurate, that information feeds into my credit score, which we'll talk about in a second. If it's inaccurate, right, it's now giving the wrong information into a credit score. So that's where I want to fix that up. But if my credit report's accurate, then I think I'm pretty good to go. Now, credit score, and in Canada, we've been obsessing about our credit scores for the last, call it 10 years. What a credit score is, it's a predictor of how likely you are to pay back your debts. So what that means is that the higher the score, and it can go from 300 to 900, but the higher the score, the more likely you are to pay back your debts, which means you're a better risk. So that's when people brag about their credit scores being so good. It means they're a good credit risk. Okay. Now, what credit scores are comprised of, and there's a fancy algorithm that nobody knows the code to, but it's basically your payment history is 35% of your credit score. That's what it counts for, right? So making sure that you are making your payments on time, even if it's just minimum payments, is crucial. What's interesting related to that, though, is that we notice here at Money Mentors when we do financial counseling is that folks will have really good credit, but they'll have a ton of debt. And you kind of go, how did that happen? Well, what happens is that someone services their debts by making minimum payments, and that increases their credit score, right? So that credit score is really important, or that minimum payments is really important. The utilization, how much debt load do you have, right? If you're using your credit card past 50% of its limit, right, it starts to look like you need this, even if you're paying it off every month. So try and keep that below 50%. The length of credit history, right? My credit, given that I'm, 50, I have a much longer credit history, right, than my niece who's 23, right? So assuming I have good credit, right, that will add to that. The new credit applied for. So this is every time you apply for a credit product, it is showing up on your credit report. The more times you apply, the lower your score goes, right? So that's where I always say, if you've been denied, if you've been declined for a loan or a line of credit or even a credit card at one bank, try maybe one more. And after that, just stop because it will start to impact your credit score negatively. Okay. And then maturity. How long of a file do you have? How old are your debts? Now, what credit ratings are, if these are different than credit scores and credit reports, is that, remember I was saying on your credit report, you have a trade line, right, for every product. So I have a Scotia Visa. Okay. So every product that I have has a trade line, and every trade line has a rating, a credit rating. So I'm going to explain them. They go 1 to 9. So 1 means you're paying as agreed. You're making your minimum payments, you're making higher than minimum payments, or you're paying it off in full. So that's where somebody who is paying off their credit card in full can have the same credit rating as someone who's making minimum payments because it's paid as agreed. If you miss a payment, it goes down to a 2, miss another one, goes to a 3, miss another one, you're at a 4, miss one more, and you're at a 5. By 5, okay, by the time you hit a 5, you're at about 120 days behind on payments, okay? But it hasn't gone into collections. But now let's go one more month, and now it slips into collections. So now we go all the way down to 9. So a 9 is the worst credit rating you can have on a product, right? Means it's a bad debt, a written off debt, a debt in collections, or a debt that's been settled or you've gone bankrupt on, right? That's what we want to avoid. If we go up one more, okay, an 8 is a repossession of an asset, like a vehicle, okay? Go up one more, and 7 is a restructuring of a debt. So whether that's OPD, orderly payment of debt that we administer, the debt management program that other nonprofit agencies administer, or the consumer proposal that licensed insolvency trustees administer. And if we go up one more, there's 6, but the reality is there's no 6 in credit ratings, excuse me. We don't know why, but there's no 6. Okay, so improving credit. A lot of people worry about their credit, but the way I see it is that I worry about my credit score when I have to go buy a home and or I have to go buy a vehicle. Otherwise, my credit score can go up and down. And your credit can go up, it can also go down, and then it can come back up. The ways to rebuild credit are, of course, pay your credit products on time by making at least minimum payments. If you can pay them off, even better. Keep your usage down below 50% if possible. Get a cell phone contract in your name and obviously make your payments. Get a secured credit card in your name and make your payments, or get a small unsecured credit card. Put your Netflix bill on there, right? Don't use the credit card if you want to just do that. Put your Netflix bill and then have an auto payment so that you're building credit by doing that. And remember, even if you have low credit, by just doing a couple of steps and by making minimum payments, you could improve your credit in time. Okay, so what about business expenses? Well, this is where it's really important, as we were talking about at the beginning, is to separate out business and personal expenses, right? Because once they get smooshed in together, it gets awfully complicated. And the way I see it is that if all of us have $100 of mental energy every day, how much, money or mental energy are we using just to kind of keep organized? So that's where, at the beginning of the session, we talked about getting organized. By getting organized, that frees up some of that mental energy to grow your business instead of worrying about where all your receipts are. Okay. Use a separate account. Get a corporate credit card. Okay. Even if you can't get one, for the business, you can get one in your name, but you use it only for the corporation or the business. Okay. Keep receipts of everything. It never hurts to do so. And then when you do your taxes, right, that will help you. And then log your receipts monthly to prevent the overwhelm, right? I imagine right now it's tax time, it's April here. And of course, businesses are scrambling to get all their receipts together, so that they can file their taxes. If you do this on a monthly basis, then when you hand this over to your accountant or your bookkeeper, right, we can all breathe a sigh of relief because it's organized. It'll save you mental energy. It will save them time, therefore probably end up saving you money too. Okay, so tucking a bit of money aside, so savings. There's a couple of different little, challenges, if you will, that I love to talk about. A couple, the thing about savings is that it can downgrade, especially having emergency savings, It can downgrade an emergency into like just a total inconvenience when you've got the cash to deal with it. When it's an emergency and you don't have the cash to deal with it, it becomes a crisis, right? And what we want to do is bring it back down. So if you tuck away $39 per paycheck and you get paid biweekly, so 26 paydays a year, you'll have $1,014 by the end of a year. Now, $1,000 again can get us out of a lot of jams, right? A hot water heater, a car breaking down. You can look at what's called the 52-week money challenge. I love this one. Week one, you put, and it can start any week, you put $1 into your savings account. Week two, you do two. Week three, you do three, right? So you from one, then you go two, now you have $3. And on week three, you have $6, right? And it keeps adding up into $1,378. Now, there's another one before I talk about savings, saving all cash and coins, is that there's a dime challenge, and this one's pretty cool, but I think it's challenging, but you do it for 365 days. So day one, one dime, so 10 cents. Day two, two dimes, so 20 cents, and you keep adding it up. Over the course of the year, you will save over $6,000, which is insanity to me, right? So for me, it's never about go big or go home when it comes to savings. It's about put money aside, just tuck a little bit aside every time you can, and you'll notice that it does grow. And that includes cash and coins. If you are at Tim Hortons and you pay with a 20, grab the change and put it in your glove compartment and save that, and every week go put it in a jar, right? If you've got coins in your purse or your pockets or wherever, grab those and put them in a big water bottle. And, you'll be surprised at what you can save in the course of a year. Okay, so I love this puppy. So keeping your head and your heart. Okay. This can be tough, right? Especially, it's tough to be a solopreneur or business owner. It's also tough to manage your personal finances. And then to do both of them can be really challenging, right? So what's important is that we do keep our hearts and our heads. And how we can do that is we give ourselves an allowance for guilt-free spending. In our household, where the rules are it's got to be legal and it's got to be moral, right? But you can go spend your allowance on anything you want, and we can't, I can't, there's no judgment on it, right? But even if you give yourself like just even 20 bucks a month, granted it's not that much, but you know what? Maybe that's a really fancy coffee and a sandwich, and that just, gives you some delight. Okay, connect with a bookkeeper or an accountant if that's not your specialty. It's important that you keep your finances on track when it comes to business, because you do not want to get into hot water with the Canada Revenue Agency. Okay, this is where you want to pay your taxes. And if you're unable to do so, do not hide from CRA. You need to contact them. They're actually really decent to work with when you are active or proactive in communicating with them. They can reduce interest, they can reduce penalties, right? They can give you a bit of a break. But if they can't find you, that's where they'll start to get a little, they'll get a little spicy with you, right? Which means they'll freeze your accounts, they'll take money out of your accounts, etc. And then you can't pay for your mortgage or groceries, okay? And then as well, find ways to create joy as you grow your business. The destination, it isn't the point. It's the journey, right? Getting there. So finding ways to enjoy your journey, I think, can help you as well. Thank you, everyone, for attending our webinar. We do appreciate your attendance. A big thanks to TD Bank for their support for our Fresh program. Thank you. And thank you, folks, for attending our webinar.